For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Yeah, this is Managing Your Financial Future. We're back. We are back. Well, we weren't really away, Professor Plum. Were we away?
We took an extra week off, though, didn't we?
Well, yeah, we did because we had the 4th of July, which if you're listening to this the day it comes out, as they say, the day it drops, the 4th of July was last week. And so we
didn't want to send out a podcast during the 4th of July.
Well, you know, I like people paying attention. That's one of those weeks because the 4th of July was on a Thursday, right? I believe. So. And anyway, but you know, that's one of those weeks that people are just kind of, it's already summer. So they're already having a hard time paying attention. But so anyway, welcome to the podcast. I'm Johnny Dean, your podcast host, here with our buddy, Professor Rick Plum, CFP, Certified Financial Planner, Professional, the advisor part of this particular podcast. Boy, I tell you what, we had some great shows during the time we were off. We weren't really off. We just, you know, we just take time between
we just
seasons.
didn't do a podcast.
We didn't do a podcast, but you heard some really good ones. And we're starting the new season. We're going to have, I believe, a guest on next week's episode. I'm working on that right now.
Cool.
All right. So we're...
Are you replacing me?
No, I'm going to have you in here.
Oh, okay.
I'm going to have you in here.
I thought I was going to have a week off again.
No, I don't give you weeks off, especially after we just came back from 3 weeks. So here's something that's been stewing for a little bit for a while. First of all, I don't want to get into the confusion about Roth IRAs because that's probably a topic for another discussion. Believe it or not, now the Roth IRA is what, 25-something years old?
26 years old.
26? Is that what it is now?
It came out in 98.
Yeah, was it
first year we could contribute to or convert to? It was in 1998.
1998. Back then, the limits were, I believe, $2,000.
I think so.
I think it was $2,000.
And the limit to be able to contribute were a lot lower.
Yes.
And
you mean the income limits? Yeah.
And to convert, there used to be a $100,000 limit. If your adjusted gross income before the conversion was $100,000 or more, you couldn't do a conversion.
Right.
They realized they weren't raising enough tax dollars doing that. So in 2010, they took that off and said, anybody can convert.
Yeah, 2010 was an interesting year for tax policy, actually.
What else happened then?
Well, the estate tax went away for a year,
for 1 year,
if you remember. And then it...
went back down to 5. Or $3.5 million.
Did it really? It went back down?
Yeah.
What is it now? It's like 13?
Well, right now it's 13.6.
All right, yeah. Per person. Yeah. So
and we have portability, so basically a married couple doing it correctly with portability could do what, $26.2 million without paying any federal.
27.2.
Yeah, 27.2.
26.2 is the marathon distance. Yeah.
And I'm so used to those. Yeah, right.
All right, so we're talking about...
Now, that's the federal estate tax limit. I know it's not tonight's topic, but some states have lower limits. Some states still impose an estate or a death tax at significantly lower estate values.
Yeah, we generally talk about federal limits just because states can
vary.
They can vary so much, and it wouldn't be worth it to single them out. But Roth IRAs. So the income limits now, Professor Plum, there are 2 different income limits to contribute to a Roth IRA, and the topic here is going to be some strategies for people who are, let's say, higher income. Okay. Ways you can use a Roth, because tax-free to somebody who's in a very high tax bracket, I think, as good as tax-free is across all tax brackets, tax-free to somebody in a high tax bracket is just by mathematics a better deal. So, but let's talk for a second about the income limits.
Has a bigger impact is what it is.
It certainly does. So very quickly, the income limits, Professor Plum, for 2024, this is when you're listening.
For being able to contribute.
Right.
And contribute new money to Roth IRA. Married couple, if your adjusted gross income is under $230,000, you can just contribute directly to a Roth IRA.
Put money in a Roth.
If your income is over $230,000, then you have to consider how far over. If you're over $240,000, you can't contribute directly. Neither one of you, neither spouse. And it's the adjusted gross income on a married filing joint return we're talking about.
Yep.
240 and over, zero contribution of eligibility.
Okay.
Somewhere between 230 and 240, it's proportional.
Right. Now, single people have a limit too. It's not half. They have a little bit better deal.
A single individual adjusted gross income 146, under 146,000, they can contribute directly to a Roth IRA. Between 146 and 161, it's a $15,000 phase out.
Yeah.
That they have the ability to contribute at least some amount. Over 161, no direct contribution to a Roth IRA.
Right. And those income limits do phase upward every year.
Yeah, they're indexed
upward
for inflation, except for the third limit you didn't mention, married filing separately. Some people will say, well, my wife or my spouse doesn't work or whatever, so we're going to file separately so we can do it. The married filing separately limits are 0 to 10,000 of adjusted gross income.
I don't know that that's ever changed.
That has not.
Yeah, ever.
That's
All right,
what it was when it came out.
So this is the thing. Now Roth IRAs, of course, Professor Plum, you pay tax. You put in post-tax money.
Correct.
And you take it out. It can grow if you're lucky enough to have it grow. It could grow, millions of %, and you can take it out after 5 years and all that.
5 years, 59 and a half.
Right.
Once becomes a qualified distribution.
Yeah,
and that means you don't have to keep track of where the money came from that's coming out. Prior to age 59 and a half, you have to keep track of if you're going to take a distribution. Am I taking a distribution of the money I've contributed? Am I taking a distribution of the money that I've converted? We haven't talked about that yet, but converted from other retirement plans. Or am I taking money out that's earnings that are coming out? They have different tax treatments.
Yeah.
Once you get to 59 and a half and you've had an IRA, any Roth IRA continuously for at least 5 years, then those are qualified distribution, and qualified distributions are tax-free. You don't have to tell the IRS, hey, this is my money I'm taking back, or this is converted principal that's more than 5 years. It doesn't matter. It's a qualified distribution. It's tax-free.
Yeah, tax-free, of course, always good. Always good. I can't think of any downside of something being tax-free. So if you are making a lot of money, then you are in a high tax bracket.
The more you make, the higher the bracket.
Now, if you are putting post-tax money into a Roth and you're making, $200,000, $210,000, you're in a pretty high tax bracket. I mean, there's a cost to getting that money inside of a Roth. No question, you're paying tax on that money.
Right, but you're not able to do, most likely, you're not able to do a deductible traditional IRA at that level.
Yeah.
You probably have a 401k or some kind of retirement plan at work, hopefully. So that means you can't get a tax deduction anyway. So what is my next option? I'm just going to pay tax on the money and put it in my personal brokerage account. I'm going to spend it. Well, you can do that too. Or if you're going to save it one way or the other, it's already after tax. You don't have any pre-tax options at this point when you're looking at this. So putting it into a Roth IRA then turns the future appreciation into tax-free.
So there are income limits, but the odd thing is you can get around those income limits fairly
easily.
Let's talk about a couple of strategies here. All right, the first one would be the more commonly known one, which is called a backdoor Roth IRA,
or the Roth two-step.
Or the Roth two-step. Talk about what that is very quickly.
Well, the idea is that we want to be able to put money. Maybe you want to be able to put money into a Roth IRA, but you make too much money. You're making $300,000 a year combined between husband and spouse, or maybe it's just one person making that, but the married filing joint returns over the limit. You cannot contribute, or you're a single person making more than the limit. You cannot contribute directly to a Roth IRA. And you can, though, contribute to a traditional IRA. There are no limits. There's no income limits for the ability to contribute to a traditional IRA. Yes, you have to have earned income.
That's vital for any IRA.
For any Roth or traditional, you have to have earned income. But if you make $1 million a year, you can contribute to a traditional IRA. It doesn't matter.
Right.
The question isn't, can I contribute? The question is, can I deduct the contribution to that traditional IRA? Now, if I have a 401k, a pension, some kind of retirement plan at work, I'm doing, any kind of retirement plan, whether it's me putting money in the 401k, the company putting money into a profit sharing plan, a defined benefit plan, any kind of retirement plan at work. Now I have a problem potentially with the ability to deduct the contribution going into a traditional IRA. So it's not the ability to contribute that's curtailed. It's the ability to take a deduction.
Yes,
that's curtailed.
Which seems to be the benefit of putting money into
most of the time. Yeah, I don't
IRA.
like personally. I don't like doing after-tax contributions to traditional IRAs.
Their headache
Because
down
then
the
I got to
road.
file an 8606 for the rest of every year that, when I take when I take money out of it, I can't just take the after-tax money.
Right.
It's all proportional, pro rata. It's like, it's a pain
So
in the keister.
what we want is a contribution to a traditional IRA that is not deductible in this case.
Either way, the question is, do I have any other traditional IRAs? But yes, I could make a deduction. I can make a contribution to a traditional IRA. My goal in this overall thing is that I want to have a Roth contribution. I'm not allowed to make a Roth contribution. So I'm going to make a traditional IRA deduction.
Contribution.
Yeah, contribution. And then, since 2010, we talked about earlier, there's no limit on who can convert. So I put my $7,000 into my traditional IRA and then turn around and convert it to a Roth IRA. That same $7,000, it took two steps. Contribute to the traditional IRA, that's one step. Convert it to a Roth IRA, that's two steps. And I'm basically going through the back door. And now the money that is in the Roth IRA.
You've got
It is not a contribution. It is a conversion.
Yes, and it has a different characteristic, but at least it's in a Roth.
Yeah, but it has slightly different distribution rules
But
up until 59.5.
But it's in a Roth.
But it's in a Roth IRA.
It's in a Roth IRA.
Now, the question is, was it efficient? And the problem comes in is if I have other traditional IRAs. I have a rollover IRA from my former employer's 401k.
As an example.
Yeah, I've been contributing to IRAs forever, and I've got a big IRA already in place. Now that makes things a little bit more complicated because if I convert traditional IRA money over to Roth IRA, I have to look at, do I have to pay tax on that conversion?
Yeah.
And if there is pre-tax money in my traditional IRAs already, then I'm going to have to pay tax on the conversion.
Yeah. So if you're doing this backdoor Roth, it's best if you do not have any pre-tax money sitting around in any IRAs anywhere. At least you can do it. It's just
the problem is if I've got $93,000 in a rollover IRA, and I do this backdoor Roth IRA, and I cannot deduct the contribution to the traditional IRA. Now my IRA balance is $100,000. 7,000 of it is after-tax money. 93,000 is pre-tax money. When I convert the 93% of that is going to be taxable. So
Right.
that kind of stinks. And I still have the 8606 for the rest of my life. I think that's a problem. So when you're doing the backdoor Roth IRA, you do not want to have any other traditional IRAs in place.
If you do, is it better to just skip doing the backdoor Roth or?
Well, it depends. I mean,
all right.
you could potentially take your traditional IRAs, all the pre-tax money in your traditional IRAs, and if you have a 401k at work or retirement plan at work, and they accept roll-ins, roll the money all over. Take the 93,000 in my previous example and move it all over to my 401k. Now, I still have the money, it's still invested, but it's limited by the 401k option. So this may not be the greatest option for some people. Their 401k may not allow it, although most do. But now I don't have any IRAs anymore.
Now you can do the backdoor.
I can do the backdoor Roth on a tax-efficient manner.
Now, of course, you're in a high tax bracket now as you're working, presumably
yeah.
because you're making more
Big
than
bucks.
the Roth limits. But you need to also make the consideration before you do any of this as to whether or not once you're retired or you're going to be withdrawing this money, whether you're going to be in the same or higher or lower tax bracket. Right?
You do have to look at, first off, is the Roth beneficial to me at this point? Should I be doing this?
As much as I love tax-free, I have to. It's going to be
There's
sort
a
of
cost to get there.
It's going to be kind of expensive to get it into the Roth from a tax standpoint.
Sometimes, yeah. Sometimes it doesn't cost you anything more than what you're already doing. Sometimes it does cost you more. And if that's the case, what is it saving you in the long run?
Yeah.
But if we've made the decision that we really want, and I know a lot of people that are doing backdoor Roths, and luckily, a couple of years, for a long time, we weren't sure if the IRS really, we weren't sure that Congress really liked the idea or didn't like the idea, because by the very definition of only people over the limit could do it, it was for the wealthy. Only the higher income people were using this strategy, because if you weren't higher income, you didn't need to use this strategy.
Right.
So we thought maybe at Congress, but they came out and said, no, we're blessing it. This is fine.
This is fine.
This is good.
So for now, as of now, you can still do it. All right.
Yeah,
So
they can change their mind.
There's the backdoor Roth. So that's one way to get money into a Roth if you make a lot of money. Now here's another way, and this is a lesser known way. We're going to call this. It's fairly. It's as I said, it's not that well known, but it's what we would call the mega backdoor Roth IRA. Can you explain this in a nutshell?
Well, the mega backdoor Roth is not as common because you're not in control necessarily. A backdoor Roth, I'm in control. I can move my IRA or not. I know what's going on. The question with the mega, what they have called the mega backdoor Roth, is an option through a 401k. Now, when I belong to a company or work for a company that has a 401k and I participate in that 401k, I know that I can contribute up to the annual limits. This year is $23,500. I can defer my salary up to $23,500 into the 401k, and then the company can put money in on my behalf
as a match
for me, either a match, profit sharing contribution, whatever the case. The combination of those two numbers cannot exceed $69,000. Okay, well, very rarely is the match that good.
I want to know where that company is, by the way.
I want to work for that company.
That's right, yeah.
But what we can do is, years ago, the IRS said, you can make it look like you can defer more of your income and use it to fill up that $69,000 overall limit.
Okay.
And it'll look like it's coming from the company, from our administration standpoint. You're reducing your salary. The money's going into the plan, but it's kind of like it's being contributed by the company. So you're still, the $23,000 is still the salary deferral limit, but we're letting you do this other thing, kind of quasi salary deferral, if you want to get it all the way up to the limit. So let's say that you're putting in your $23,500, the company's putting in $99,000 as a matching contribution or some number. That the difference between the combination of those and $69,000, I could technically reduce my salary and put it into my plan. So in effect, I'm putting $69,000 a year away in my plan. Most of it's coming out of my paycheck. So this isn't for everybody because it's a fairly high limit. Not everybody can afford to do this. And not every plan is written to allow for this. And so but a lot of plans have come around and said, especially for people that have higher incomes, you can put a lot more. Now the $23,500, the annual deferral limit, if you have a Roth 401k at work, you can choose to put that $23,500 into the Roth or the traditional 401k or any combination, one of higher, lower, the other. The $23,500 can go either way. The amount over that you're deferring into it can only go on an after-tax basis into the traditional side. But
of the 401k.
Of the 401k. Yeah, so let's say that I'm going to contribute $40,000 over and above the annual limit. So I'm putting my $23,500 in, and I'm putting another $40,000 in. It's bringing me up to $63,500. The company may put in a couple $1,000 for me.
Okay.
We're under the $69,000 limit. But that $40,000 goes into the traditional 401k as an after-tax contribution. And I do this for 10 years. So I've put in $40,000 a year for 10 years. I've put in $400,000 of after-tax money into this plan.
You've had a lot of money to save, by the way.
I've done very well.
Yeah.
And it's grown. So there's earnings on that $400,000. Maybe it's up to $750 on just that portion.
Okay.
The $350 of this example of earnings are part of the pre-tax money because I haven't ever paid tax on that money. The $400,000 is after tax. I retire after that 10th year. All the pre-tax money that's in the plan can go to, I can roll it over to a traditional IRA.
If you want.
The after-tax money, that hypothetical $400,000 that I've put in, $40,000 a year for the last 10 years, I can roll to a Roth IRA. So that's one way to get, that's not a bad, $400,000 in a Roth IRA is not a bad thing to start your retirement with.
Now, you mentioned doing this after you put in post-tax money in your 401k and you let it grow for 10 years. Do you have to do that? Can you do it every year? Can you take I
can change the amount that I save every year.
No, but can you roll this into a Roth? Do you have to wait 10 years to do this? I know this is a question people are going to
ask. The problem is if I'm converting from the traditional 401k to the Roth 401k, it's a pro rata it's a pro rata conversion.
Yeah.
So assuming I already have money, it becomes a problem. But if I have no other money, but I do have other money most likely because I'm putting money I'm probably putting the 23,000 into.
Really, what you're doing for this mega backdoor Roth that we're talking about, I don't want this to
building
get
it up for retirement mostly.
Yeah, I don't want this to get too confusing. But what you're doing is taking this post-tax money out of the 401k and you're putting it into a Roth
at retirement.
At retirement.
At retirement. That's when it happens.
Yeah.
And you're getting the growth. I mean, it's kind of it's a half step. You're getting the growth tax deferred, and you're also starting off retirement with a large Roth potential. It's
as we're explaining this, it can get confusing.
But not every company allows it.
But if you make a lot of money,
and realistically, it's probably if you have a company where a lot of people make a lot of money. If one or two, they may or may not allow it. And if you're the one that's making the money, you probably know whether you can do it or not because you've already asked your 401k administrator, "Can I do this?"
Yeah.
But if you're in a plan or a company where a lot of people make way over the limits, you could get a lot of people and say, "Hey, let's see if we can get this passed so we can save more money."
Well, that's a way to do it. Now, you mentioned another way to do this, Professor Plum. You said the Roth 401k. Now, this is a potentially another way for people who are in a high tax bracket or making a lot of money. But if you make too much money to put directly into a Roth IRA, you have the Roth 401k option.
Right. We talked earlier about the income limits, the adjusted gross income limits for contributing to a Roth IRA. Married filing jointly, 230, 240 phase out. If you're over 240, you cannot contribute directly to a Roth IRA. But they do have these things called Roth 401ks. Company sets them up, are very similar to the traditional 401k. You can contribute your $23,500. You can choose to put it into the traditional or the Roth 401k if they offer Roth 401k. You can put it all into the Roth 401k, and there are no income limits. You could be making $1 million and put the contribution, the first $23,500, all into Roth if you want, and that now becomes a decision-making concept. What is the benefit? If I'm in a really high tax bracket now and I put it into the traditional IRA, I get a tax deduction right now.
You mean the traditional
401k, excuse me.
Yeah.
Then I get a tax deduction for doing so. Will my tax bracket in retirement save me enough money that this makes sense? Or have I already put so much money in tax deferred and I have a pension and I have income that my tax bracket in retirement is going to be even higher in retirement than it is today? And if that case, I'm going to forgo the tax deduction today, do the Roth so that I can get the tax-free in retirement.
What you're saying is you need to determine whether paying taxes now is better than paying
I got to do a little cost-benefit analysis here.
Yes, because there's a cost to doing either one. There's a cost to doing the traditional. That is, I get the benefit now of the tax deduction, but I got to pay taxes later. Or do I pay taxes now? Don't have to worry about taxes later, but was it worth it?
Right.
Am I paying taxes in a 22% bracket only to find out that later on I could have been taking it out in a 12? Well, I didn't do wasn't such a good deal for me.
Right. So it's just a matter of cost and benefit.
Yeah.
But Roth 401ks are very popular. They work really well. And I see a lot of people, especially as they get closer to retirement, who have already built up decent-sized tax-deferred accounts. They start to go, 75-25 contributions, 50-50. And by the time they retire, they're 100% Roth because they want to build up some more tax-free money so they can periodically, they'll take their income from the traditional tax-deferred accounts. So they know they're getting $5,000 a month, whatever from there. But if they have an issue where they need a car, they have large one-time, periodic expenses, they want to be able to draw that from the Roth side so it doesn't affect the stability and consistency of their normal income stream.
I could see that.
It's not a problem.
And the other nice thing about a Roth 401k is, just like a Roth IRA, Ed, when you get to required minimum distribution age, there's no
that's new.
That's true. No, but I'm saying
there's no required minimum distribution from the Roth IRA
or the 401k.
The Roth 401k now. That is new.
New. It was last year,
either this year or last year, but real. Secure Act 2.0 did it to it. Gave it to us.
I just hate to not mention that because
that's a good thing.
It's a very good thing. It's one of the nicer things that they've done for us. Okay, the last. So you got a Roth 401k. Your company does need to offer the Roth 401k option.
You need to petition them and push them and say, hey, you need to retain your employees by giving them what they want.
Yes. And then finally, the Roth conversion. You already talked about this a little bit. We know that there are
conversions are great, or can be.
They can be. We don't want to say that Roth conversions are great for everybody. It's lovely to have money inside of a Roth, but again, this comes down to
cost benefit. Is
the cost now worth the benefit later on?
Now, the nice thing about conversions, and this still takes people, sometimes they don't think of this. You do not have to have earned income to do a conversion. You do have to have earned income contribute, but anybody can convert existing tax-deferred IRA, 401k type monies to a Roth. Retirees can do conversions. It's amazing how many times I get the question, and we talk about conversion. Well, I can't do a conversion. I'm not working anymore. Oh yes, you can.
Yeah.
You can convert. Now, it is a taxable event. And when we're dealing with planning and we're dealing with how to allocate the assets, basically, how do we set up your buckets plan? The buckets, the idea that you set up your investment strategy to create the cash flow that you need. But if you also want to incorporate conversions into your long-range planning, conversions don't have to be part of your cash flow. Let's say I've got my proverbial $1 million and I want to live on $40,000 a year, 4% distribution. I set up my investment strategy to provide that $40,000 of cash flow every year. But let's say I also want to convert $40,000. I'm making numbers up. I don't have to then turn around and set up my cash flow to create $80,000 a year to cash flow, $40,000 to live off of, and $40,000 to convert.
In your bucket strategy.
No, I don't. My investment strategy does not have to do that because the conversion does not have to be in cash. The conversion can be in the exact asset that you already have. And so it can be done whether the market's high or low, because if I have, let's just take the most popular thing out there, an S&P 500 index fund, and I want to convert $40,000 a year because that's how much I have in my bracket available to me, or I can just take however many shares it takes to create $40,000 in value and move it from my Roth IRA to my personal brokerage, from my traditional IRA to my Roth IRA, and that's a $40,000 conversion. I didn't have to sell it. And the idea is if the market's volatile, I either convert more or less shares. I don't have to have cash. So we do an investment strategy to create cash flow for retirement and also to look at maybe what we're trying to spend on. Right. But we don't have to do it for conversions. Conversions are the same thing. RMDs do not have to be done in cash.
Well, and that's the nice thing. I mean, you can do this to a bucket 3. You can do the conversion to a bucket 3.
You probably want to use it in a bucket number 3 because if you're converting, it means that you have some time for that money to sit because you're not converting today to take it out next year. Yeah. And rare, I can think of a couple of cases where you would do it, but very rare. But most of the time you're putting aside for the surviving spouse, for the kids, for legacy planning, for future planning. And so by definition, it's a bucket number 3. And so let's convert long-term growth. And so you don't have to change your investment strategy to do the Roth conversions.
It's Roths, as we said, have been around since 1998. So now we're 26 plus years into this world. They really added a fun element to this whole retirement planning puzzle, I would say. But you have pre-tax money, you have personal money, and then you've got tax-free money, which we'll throw which is the benefits. Roth.
And a lot of people, except for the more wealthy you are, the less likely to have a high amount of your money in tax deferred. But the normal retiree has a fairly large amount of their income or their assets in pre-tax money, their 401ks, IRAs, and things like that. And they're like, well, tax, now that I'm retired, conversions aren't for me. That's not necessarily true. There may be room in your tax bracket to do conversions, especially between now and age 73 when the required minimum distributions kick in. And so we just have to look at your tax bracket. So when you go see an advisor, bring your tax return.
It would be helpful to do that.
It's very informative. If it's not informative to your advisor, Find one there. It is informative too.
Like Lucia Capital Group Advisor. Well, what a great segue you threw me here. These are the kind of things that you guys at Lucia, we as advisors at Lucia Capital Group do. You do this all the time. This is one of the most common things I would suggest. When you go over somebody's plan, you look at their tax return. You say, I know exactly where to look. I'm going to see where we're being efficient.
What pitfalls are we looking out for in this tax return?
Right. Based on whatever your goals are and your needs and all that stuff.
Social Security taxability? Is it a bracket issue?
Yeah.
Is it a net investment income tax issue? Is it an IRMA issue? There's just something at every level to have so much fun with.
Fun for you on the other side of the desk.
Yeah, whatever.
I would say just explain to me what you're doing, and we'll leave it at that. Talk to any of the Lucia Capital Group advisors, including Professor Rick Plum, 800-644-1150, the number at Lucia Capital Group, 800-644-1150. Go online at luciacap.com, luciacap.com. I've been mentioning this. We did this during the previous season, and it continues. We've got at Lucia Cap, we've got the Bucket Strategy Guide, free for you to download. Read all about how the bucket strategy, not a bucket strategy, okay? This is the bucket strategy. It's like getting the formula to, Coca-Cola. There are a bunch of other, imitating colas out there. But, hey, you want the secret formula? This shows you.
You don't want new Coke.
You don't want that. There is no new bucket strategy. This is the bucket strategy. Just type in bucket strategy in the search bar up top, and you'll be able to download this as a PDF and read it. We've also got an estate planning guide up there. We've got a few other guides, and check out luciacap.com. Make sure you do that. It's helpful when people understand how the bucket strategy works. When you work with them, right, Professor?
Oh, it's very helpful because it helps satisfy the needs. It helps protect against the market volatility.
Yeah.
Also identifies when you can take opportunity from market volatility. But it also helps from an emotional standpoint that we don't have to be afraid of market volatility.
Yes, it's about segmenting.
Because market volatility is going to happen.
Absolutely. There's nothing we can do about it. You can sit and watch it happen. You can be worried or you cannot be worried. That's why you strategize.
I did notice that I mentioned a couple times during the earlier portion of this that I said 23.5. It's 23,000 even
23,
for 2024. And the $7,500 catch-up contribution is in over and above anything we were talking about on the 401k before.
Yeah, 50,000. I'm sorry,
50,000.
Age 50 or older.
Age 50 and older is 30,000.
50 and older, yes, it's 23,000, and you can contribute up to 30,500 if you're age
7,500 catch-up for the seasoned citizens of 58 years of age. And 50 is the year you turn 50, not the date you turn 50.
Important to know. Well, all kinds of things.
I've had people ask me, they say, well, I can put in my $23,000 and you divide by the paychecks, but then I don't turn 50 until December. How do I get that extra $7,500 in December?
Right.
If I'm already putting basically almost $2,000 in, I got to make $9,500. Now, it's the year. I can start doing that in January of the year I turn 50. I can go to that higher $30,500 limit.
Yeah, kind of nice to have, especially if you got the extra money to save.
That's the 401k limit.
401k.
Same thing works with the IRA limit, which is an extra $1,000, $7,000 annual contribution, up to $8,000 for those 50 and older.
Nice to have. Once again, luciacap.com or 800-644-1150. Subscribe to this podcast, would you? That's an order. I'm putting a direct order to everybody listening. If you haven't subscribed, do it, all right? You want to listen to every single episode of this particular podcast. You never know what you're going to miss. Don't miss a single episode of Managing Your Financial Future. Thanks again, Professor Rick Plum.
You're welcome.
CFP professional, certified financial planner professional. I got it all covered. Right?
On that side, yeah.
Okay. Oh, that's right. Aggregated wheat management associate.
FinDoc.
That's right. Aggravated doc surge.
Yeah.
That's what it is. All right. Well, we'll get that next time. I'll put that designated in. For Professor Rick Plum, I'm your podcast host, Johnny Dean. Thanks for listening. Talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time and without notice. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k plan information used is obtained from sources believed to be reliable as of the current date, but no representation is made as to its accuracy and completeness. Benefits may be subject to change at your employer's, the governing pensions, or benefit organization's discretion. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.